All right, well, stocks have lost a bit of their groove just in the last few minutes. We started the day with continued buying in New York after a big rally yesterday. The confidence picture is one we're watching very closely, especially in the face of tariff uncertainty. We just got some consumer confidence numbers for the month of March in the U.S., where the data fell to a two-year low. Let's get some more perspective on the mood of the markets now from John Zechner. He's chairman and founder of Zechner Associates. John, it's nice to see you. And I was curious to know how the market might respond to the next consumer confidence reading, just because that seemed to be one of the early signs that maybe the U.S. economy was going to start looking wobbly. Give us a sense on what you're seeing in investor behavior of late.
Yeah, you're seeing a lot of this soft data, John, certainly roll over. I mean, the consumer confidence number, U of Michigan, the conference board, that's all been lower. And then you got things like last night, KB Homes. You saw then the airlines, the way they've sort of revised their numbers from January to March now, a huge difference. The retailing numbers have all sort of come in soft. So clearly, the economy is slowing down. There's no doubt about that. So that's the tariff risk. So I'm going to be very interested once you start getting the reporting of first quarter earnings. Well, what companies see going forward and what their the capital expenditure plans are and things like that. In terms of the market itself, John, I mean, the market got pretty oversold on a sentiment basis. We saw the sharpest 1 month drop basically ever in the sort of in the investor bullishness, drop from sort of euphoric levels down to desperate levels. So a bounce was in the cards. But having said that, investors may have changed their opinion or their worries, but they didn't really change their positioning. So you still got over 70% of U.S. assets in the stock market. That's a worry. You still got low cash levels of mutual funds. Hedge funds may have unwound some of their aggressiveness, but that's why I'm sort of interested in the stock market later in the day as opposed to the morning. If you have gains, can they hold on to them? Yesterday they did, but yeah, I think it was just an oversold bounce.
The part that we haven't talked as much about recently, just because there's so much tariff uncertainty, and now we're on to the election story here in Canada, but is what happens with interest rates. Now, I think obviously there's an expectation that rates could continue to come down in Canada, but the market is also trying to figure out what the U.S. Federal Reserve's thinking is going to be. And so when you have a weaker confidence reading come up, but you've had a Fed that's been sort of pushing back on the idea of rate cuts in the near term, give us a sense on what you think the market is working through on that front.
Well, yeah, in the U.S. in particular, John, I mean, it's a harder one to figure out in the short term because there is going to be, obviously the deficit financing, inflation is a little stickier to the upside, so it's giving the Fed less room to move. But in the end, you're going to see an economic slowdown, and you're starting to see it, and that's going to ultimately push rates lower. We've seen it in Canada, and I think the U.S. will follow suit. I look at the U.S. Treasury at 470 plus right now is almost a gift right now in terms of something that's safe yield. It's a nice hedge to what's going on in the stock market as well. So we continue to look at that as a nice spot to be. I mean, yeah, there are risks that the U.S. government could do something untoward in terms of their financing and ultimately the foreign holders of the debt. That's always a risk. But I think the U.S. dollar will continue to be the reserve currency. So these rates will act more normal and go to a downtrend. So.
Against that backdrop, Mr. Zechner, how have you been approaching these markets? Let's just sort of an example. We talked about a correction that played out with the S&P 500. Did that open the door to you looking at some buying opportunities in the market?
Yeah, a little bit more, John. We've been seeing a lot of cash, and we're in a very defensive condition. I continue to be that. Like I say, in a view that the world economy is slowing down, the U.S. is slowing down. I don't want industrials as much. I don't want financials. I don't want consumer stocks. We're more sort of in the utility, energy, infrastructure, telecom areas like that are a lot more defensive, more yield plays than others. So we continue to look at that. But yeah, having said that, your best growth story longer term is it will continue to be technology, and some stocks got pretty beaten up. So yeah, we picked away at actually, names like Celestica on this downturn. It dropped sort of 40% peak to trough. I mean, even Nvidia came back to it. I mean, actually the multiple came into the low 20s recently. Meta, we came back to a few names like that. Those are great long-term stories. So sometimes you can get them on the cheap, but we're still pretty defensive overall. So, I mean, Problem is, I mean, just indulge me for a second, John. I mean, I think we're unwind. Problem from a macro view is you were unwinding some of the greatest growth strategies or growth drivers of the past 4 decades plus. When you look at what drove markets for 40 years, were in great shape. Why? A couple of things, because the end of the Cold War, so the old guns to butters argument, the advent of technology and what it did for productivity and gains, that drove markets. Most importantly, globalization. The old economic theory, everybody does what they do best, most efficiently, the total pie grows. And that's what drove. And the U.S. benefited from that. The U.S., their brands sort of got global basis, they expanded totally. So they benefited from that as much as anyone else, because everyone focused on what they did best. U.S., it was innovation, it was marketing, it was branding. What the U.S. does not do best is manufacturing. And if everybody sort of goes into their own hole and tries to do everything in themselves, which is what the U.S. is pushing with this tariff policy, the ultimate result is going to be slower growth globally and in the U.S. And I think that's why a lot of these policies are doomed for failure. Canada, we're in the crosshairs in the short term, so we're in a bad situation. But John, this country's been around for 160 years. I'm old enough to have seen it all from the Pearson, Diefenbaker against Johnson to Nixon and Trudeau Sr. And then 15 years later, you've got Ronald Reagan and Brian Mulroney singing "Irish Eyes Are Smiling" together. So I mean, those relationships go up and down. We'll survive the next 3.5 years. We will. But in the meantime, it's ugly. So duck down a little bit, stay defensive, look for rates to fall, but don't play in economically sensitive spots.
We're almost out of time, but I do, just because you're referencing the election cycle here, want to squeeze in, pipelines are going to get a lot of attention, I would imagine, over the next month. As an investor in pipelines, is that an area that you embrace right now?
I like them. I like energy infrastructure. We have to move our products sort of beyond the borders and into other spots. In the end, we can't undo the U.S. relationship will always be the strongest one because of geography, because of its similarity in nature, the language, everything else. But yeah, we've got to try to move our product elsewhere, which means more investment in energy infrastructure, LNG, the pipelines, whatever. And the pipelines are great valuation stories. They're high yield. They're not economically sensitive earnings in particular, and their valuations are relatively good. So, Pembina, Enbridge, TC Energy, a lot of those names look good.
Okay. John, appreciate the breakdown as always.